Welcome to my channel. I'm the covered call guy, and my goal is to create 120,000 in annual passive income using covered call ETFs to reach my goal. Right now, I yield about $76,000 a year, 6.3K a month, and about 1.4K a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video is requested by Faita Accompli 5878. I hope I'm saying that right. And Salada. Both of your requests was kind of similar, so I kind of mixed it. Your request was basically it kind of sound the same. It was to reach 100,000, not 100. It was your how to reach 100, not 100. Why did I keep saying 100? It's to reach $10,000 a month the quickest with minimal or no NAV erosion. Now, it was not specific, so I kind of added a little bit extra to it. So this is my ultimate 10K monthly income guide. I added a little bit to it, which is the goal and rule is the quickest path to 10K per month with minimal NAV erosion was your original comment, but you weren't specific in what I could use, how minimal, so I kind of added using only income ETF or stocks, ideally 5% yield or greater, must hold a minimum of 10 stocks but no more than 15 holdings. So the quickest route to 10K per month with minimal NAV erosion means also survivability and reliable, consistent, and sustainable. So that was my add-ons. If you wanted only cover call ETFs like what I'm doing, let me know and I'll go ahead and make another video. If you said, you know what, cover calls and certain and maybe 2 or 3 dividend growth income stocks, then I'll go change that up. Or you could say, you know what, a maximum of 10 or a maximum of 15, but I want at least 15 but no more than 15. Let me know when you request these type of videos. Be as specific, that way I don't go and kind of divert. But this is my play, this is my twist. Hopefully you get something out of it. Hopefully I kind of gave you a little insight and expand your vision. So let's get started. All right, step 1, the 4 rules I can't break. These are the 4 rules I'm going to give myself to reach this goal. So I have a goal of $120,000 a year. I cannot afford to be sentimental about stocks, right? The math is brutal. My goal, get 10K a month as fast as possible. My yield is 5% or greater. My safety is no shrinking money, NAV erosion, right? That was your rule. My limit, 10 to 15 stocks. Again, obviously, if you wanted just cover call ETFs, which is what I'm doing right now, let me know, because essentially I'm just going to make a video on basically how I'm going to achieve my 10K a month using cover calls only. But you weren't specific in that. Your comment didn't say that, so obviously I did a mix because other comments in my videos are asking about other type of ETFs and stocks too. So not everyone's going to be crazy like me and just go straight into cover call funds, putting $1 million in. Okay, all right. Step 2, all right, don't get caught in the safe trap. So my safe mistake was I originally thought, I should buy Microsoft. It's safe, it grows, it anchors my portfolio. I wanted to protect my principal from inflation within my 10 to 15 stock limit. But for an income first portfolio, safety at the cost of yield is a luxury I can't afford, because the rule you have given me was fastest way to 10K per month with minimal NAV erosion. So Microsoft does fit the NAV erosion part, but not the fastest way, right? So the income reality is that Microsoft yields 0.8%. To get $1,000 a month of income from Microsoft, I would need $1.5 million invested in it alone. It drags down my entire average. It forces me to take huge risks elsewhere just to compensate for its low payout. So what did I do? I said, I'm selling Microsoft. It violates the quickest path through. It is mathematically inefficient for my $120,000 goal. I am reallocating the capital into assets that pay me today, not in 20 years. So my action here was, you know what? I'm getting rid of Microsoft. I'm going to buy JEPQ. Step 3, the cheat code replacement. I'm buying JEPQ instead because how do I keep the safety of Microsoft but get the 10% yield I need? My strategy lies in JEPQ. It holds Microsoft. It's the top holding, but it sells the upside via call options for immediate cash. That's the trade-off, right? I cap my growth potential in a bull market to secure my lifestyle income today. The old yield of 0.8%, boring. My new yield is about 9.5 to 10%. My money printer. Why am I targeting 8%, right? I want to consider 8% the buffer. It is your rule with minimal NAV erosion here. The safety margin strategy, the goal is $120,000 a year. If I aim for exactly, if I lower my expectation to 7.5% yield, I kind of give myself zero room for error, right? So I have to optimize. Since I'm allowed to go up to 10%, which is my rule that I'm giving myself, because I have to follow your minimal NAV erosion. If I go above 10%, I kind of push myself in the danger zone of NAV erosion. So no, minimum 5%, which ideally don't want to hit. Maximum 10% where I can try to achieve the fastest 10K a month, right? So I'm allowing myself to go up to 10%, right? So I'm going to push my blended yield to about 8.5% here. This creates a $10,000 a year buffer. If one stock cuts its dividend, I still hit my goal without sweating too much. So the magic number here, I ended up with 13 holdings. Why 13? My rule is minimum 10, maximum 15, right? So for me right now, 13 is the sweet spot. There is 2 more that I would add, but I took it out, but I will mention it later. All right, so the 13 is the sweet spot. 1, it gives me diversity. I'm exposed to tech, real estate, energy, and credit. If one sector crashes, the other holds up. 2 is focus. It's concentrated enough to track, but I'm not buying 50 stocks I don't understand, right? I have just enough. And balance, it fits my quickest path mandate perfectly. All right, I'm not just buying random stocks here, right? So my income engine design stability is about 13%. VICI, O, JEPI, SCHD are going to be my anchors. My credit is about 25%. ARC, ARCC, Main, these are the bankers. Infrastructure is 25%. EPD, ENB, UTG, these are the pipelines, right? And then accelerators are my 20%. JEPQ, PFFA, these are the boosts. Now I would add 2 more 15, but I'm gonna mention it later and why I didn't. All right, how I get paid when the market crashes? Harvesting fair for cash, of course, right? I don't just hope the stock goes up. I manufacture my own dividend. These fund sell ELNs, equity linked notes. Think of these as selling lottery tickets to other investors. When the market is scary, the ticket costs more and my dividend gets bigger. Why am I doing it? It's the only way I can get more than 8% yield from high quality companies like Apple and Amazon. Right? So I have to do this in order to give the trade-off for growth. Okay, my personal private bankers are my ARC and Main. These are the 2 credit kings. Absolutely love these 2. Banks stopped lending to medium-sized businesses, so I stepped in via these 2 stocks. These 2 stocks' main business is to lend out to medium-sized businesses. My rate, the loan have variable interest rate. When the Fed keeps rates high, my check gets bigger. My safety, ARC focuses on senior secured debt. I get paid first if they go bust. This presents the dreaded NAV erosion. So these 2 are gonna have stabilized in the credit area, the credit kind of diversification there. The 9.5 yield shield. What is preferred stock? It is my safety net. It sits higher in capital stack. Companies are contractually obligated to pay me. They cannot pay their common shareholders a dime until they pay my dividend first. Why did I add PFFA? Most preferred funds yield about 6%. PFFA yields 9.5%. It uses leverage to juice the returns. It's risky, yes, but it is an essential accelerator to hit that $120,000 goal quickly. Now, I'm going to mention I could have put up to 15, or I can replace this with either SPY or QQI. Now, you don't have to even remove PFFA and just add these two to make it 15. However, I'm pretty sure it's going to be mentioned why I didn't pick it. So I originally have these two to make up 15. But one of the rule was I need to know if it wasn't going to give NAV erosion, right? So that's the rule you set for me. And I could pick SPY because it has a track record, but I couldn't pick QQI because it is still too new. Now, if you say minimal NAV erosion, I can't faithfully say that. As much as I love Neos, I can't say the two duels of SPY and QQI won't have NAV erosion because of the historical data that I can't lean back on for QQI. SPY has a pretty solid track record, but QQI does not yet. Do I see it performing excellent going forward? Yes, but I didn't put it because, again, I can't faithfully say I looked back at a minimum of 3 years, right? I want to be able to say, look, it has 3 years of track record, so I didn't add it. Now, if you prefer to add it, sure. Now you made your 15, and you boost up your yield from 8.5 to like a little over 10%, and you reach it faster. But I took it out just because I can't put it in there and say, look, it has a track record. So your rule was minimal NAV erosion, so that's why it got taken out. All right, inflation proofing my paycheck, right? I buy real things. Paper money loses value. Pipeline and casinos do not. That is why I have these two. VICI. Can you build a new Caesar's Palace tomorrow? No. 50% of the rent rises with inflation automatically. And an EPD, pipelines or toll roads of the economy. I charge a fee for every barrel of oil that flows. This is my reliability layer. All right, the one low yield stock I am keeping is SCHD. Yes, it only yields about 3.5 to 4%. Am I breaking my own rules? Yes, but I am allowing for one exception for this. SCHD is my growth anchor. It grows its dividend by 10% per year. I needed to ensure that in year 10, my 10K month still buys 10K worth of stuff, right? It is the new, and it's not new, it's the only low yield stock I permit. That's it. If I find something better, I will replace this. But right now, it does have a CAGR of 10% or more per year. I need this to grow. It fits my minimal NAV erosion, right? So this one will hold. This one will stay. All right, the crash test. Will this survive? So I put it against 2008 repeat. The risk is credit freeze, loan default. My defense is ARK survived 2008 without cutting its core dividend. They lend to essential businesses, not speculative tech startup, right? The scenario here, I put it against also, is inflation spike. The risk, cash becomes worthless. My defense is VICI raises rent, EPD raises tolls, floating rate loans ARK pays me more. This portfolio is built to fight inflation. Again, another reason why I was very hesitant to have SPY or QQI to help kind of juice up the yield and kind of make the 10K per month reach my goal faster. So you can see why I kind of took it out. Now, if your risk tolerance is a little bit higher and you're okay with it, sure. But remember, these were your rules. Fastest way to 10K with minimal NAV erosion. I couldn't I couldn't say, um, it would survive a 2008 repeat without massive NAV erosion. Could it recover? Sure, but that wasn't your um you should have mentioned it then. Next one, right? Next video. What if I don't spend the 10K? Well, okay, this is just a scenario. The power of reinvestment. I hit my 10K goal a month, but what if I just reinvest it for 5 years? Starting at $120,000 a year, year 5, I get $180,000 a year. This is the snowball. My income buys more shares, which pays more income. It becomes an avalanche of cash. And then these are just the final optimized numbers. If I re-rate the portfolio to take advantage of the full up to 10% year allowance, right, then my tech category, JEPQ, my allocation becomes very aggressive with 20% of it, yield about 9.5%. My credit kings of ARK and Main, 25% of 9% yield. Preferred PFFA, 10% with a 9.5% yield. Infrastructure, EPD, ENB, UTG at 25% with a 7.5% yield. And then stability is JEPI, VICIO, my SCHD. My allocation is 20%. With a 5.5% yield, right? So the holding is about 13 holdings, with my allocation being 100, and I yield about 8.2%. Annual income is about $131,000, right? My monthly is about 10.9K. So I juiced it up to get more, to hit my monthly, basically. So not bad, right? All right, the catch, right? Risk and taxes. Of course, there is the tax drag. These holdings does create an ordinary income. If I hold this in a taxable account, I lose up to 30% to taxes. My solution, I put heavy hitters, ARK, PFFA, JEPQ inside my IRA. If I have one, I shield my income from the tax man. But again, this whole point is to actually use the money. Unless you're doing this to reach 10K without actually using it, then IRA makes sense. All right, total return lag. In a raging bull market, I will likely lag the S&P 500. My mindset, I don't care about beating the index. I care about the 10K a month hitting my bank account every single month. The goal here is income, not beating the S&P. All right, mission accomplished. Well, I do think this is one of the most optimized path because I was honest about the math here, right? I mean, I had to follow the rules here. I removed the feel-good stocks of Microsoft that don't pay the bills. I lean into the 10% limit and create a $10,000 a year safety buffer. I selected 13 elite top-tier holdings, in my opinion, to satisfy my minimum 10 and maximum 15 rule with 10,933 month secured. If you agree, let me know. Smash that like button if you agree. And even if you don't disagree, just help me out here, right? All right, well, the fastest way to $10,000 a month with minimum NAV erosion is to win the lottery. That is actually the fastest way. So hit me up if that ever happens, because you know what? You don't even need these 13 stocks. You can just put it in a CD or whatever, and that will yield you $10,000 a month with zero NAV erosion. All right, so comment below. Do you agree with my picks? Is it too conservative? Is it too moderate? Not risky enough? Let me know. And if you want another request of video, let me know too. I will make it this time. If you want, be a little bit more specific. Hey, for those watching, if you want a video requested, let me know. You know, hey, you can say, look, I'm 35 years old. I have this income, this invested. This is my goal, and I'm gonna try to create a portfolio specific to you, and we'll see how that works out. This is it. It makes me a better investor. It's fun for me. Hopefully, it's educational, informative, creative, and fun for you too. So if it is, give me a subscribe, like, and leave a comment. I really appreciate you guys helping me out in the channel. Catch you guys on next. Thanks for watching. Stay tuned.